Hi everyone, how are you? Today I will be talking about the random walk theory, and the statement that I will be discussing for this video is that the random walk theory, which implies that investing in stocks is like playing roulette, is a powerful indictment of our capital markets. Now, first, let's talk about what the random walk theory is. This theory suggests that stock prices move in a completely unpredictable manner, which means that past price movements of stock are not really helpful if someone tries to predict the performance of a certain stock when investing. Now, what does this imply? It implies that the stock market is like flipping a coin or spinning a roulette. Basically, in the short term, it's pretty much a gamble whether or not you're going to have success with these investments. Now, what does this statement mean if the random walk theory is true? It means that there is no way for investors to consistently outperform the market by analyzing past performance. Now, if we follow this train of thought, stock picking is basically like gambling and very much a game of chance rather than skill. This basically means that skilled investors will not be rewarded differently than anyone else when they invest in the stock market specifically. Under this assumption, obviously, no one will have an informational advantage when it comes to stocks, unless we're talking about insider knowledge, which would fall into insider trading, which, as we know, at least in this country, is considered to be outside the law. What does it really tell us about the stock market? Since investing is random, according to this theory or this assumption, it suggests that capital markets don't fairly reward skill and analysis in investors. Now, on the other side of the coin, there are some other theories that debate the randomness of the market, such as behavioral finance, which considers that investor behavior is a factor that affects pricing. We have also seen some examples of investors that have clearly really benefited from stock investing for a long time and long term, especially, the famously known Warren Buffett is a good example. Now, after looking at both sides and doing this research, and from real life experience, things that I have seen firsthand, my conclusion is that while short-term price involved movements may resemble randomness, long-term performance of a company is not really random, but is influenced by performance, economic conditions, and the psychology of the investor. So that means that I do think it is possible for an investor to benefit from the stock market in the long term, with some strategies such as diversified investment and long-term analysis and learnings. Thank you for listening.